Awesome. Well, thank you all for joining us today. Hello, my name is Sean Connor, and I am the co-founder and chief progress officer at ForceBrands. For those that are new to ForceBrands, we help brands connect with talent within the CPG industry. We have 3 different divisions, starting with our retained executive search division for C-suite, VP, and board of director opportunities, which is called Impactful Search. We also have a direct hire model for director and manager level opportunities. And lastly, we have a self-service job board for junior to mid-level management job opportunities, which is on forcebrands.com. Today, we're going to talk about trends impacting the CFO and finance teams. Before I introduce our incredible panelists, I want to give some background on today's conversation. At the beginning of 2022, we have seen an increase in demand for finance talent and the importance of hiring a great financial leader. And that demand is only continuing in 2023. Given the current economic climate and the current changes in the market, we wanted to bring together 3 of our industry's best to share insights and trends on how the CFO role is evolving. We also want to discuss some strategies that companies are leveraging in this economic climate as it relates to banking, profitability, and more. We also want to provide some advice for aspiring CFOs. So let's kick it off. Today, it's truly an honor to be joined by 3 incredible panelists, starting with Liz Carter, who's a senior executive who has a successful track record scaling high-growth consumer packaged good companies, specializing in food, beverage, and dietary supplement categories, and she has held numerous financial executive leadership positions at the C-suite and board roles at brands like Hunk Kombucha, 5 Hour Energy, Perfect Snacks, and Goalie Nutrition. Currently, Liz is president and COO at Chomps and has recently taken on a board of advisor role for Petite Pot. Second, we have Raj Babu, who is partner at BFG Partners, a private equity firm that partners with early stage consumer product companies whose products do better for people and the planet. Prior to that, Raj served as president and COO of Birch Benders, which was eventually acquired by Sovos Brands. He has held the role of president of Cabela's. Before becoming an operator, Raj spent several years at BCG, Bain, and Morgan Stanley, which eventually led to his roles with White Wave Foods, where he held a number of strategic leadership positions. And last but certainly not least, we have Taylor Burroughs, who's a global CFO at the NotCo company, where he's responsible for overseeing critical finance, legal, and IT functions across 6 countries and 2 lines of business. Since joining NotCo a year ago, Taylor has led a $70 million financing round as an extension of NotCo's Series D. He revamped the company's banking and treasury operations and overseen additional transformational initiatives. Before that, Taylor spent 9 years in various roles at AB InBev, including 3 years at the company's venture capital arm, ZX Ventures. Thank you all for joining me on this discussion, which is certainly relevant, and I'm excited to kick things off. Why don't we start with everyone's favorite buzzword, profitability? Liz, would love for you to open it up. How do you work with teams to understand the trade-offs between profitability and growth?
Yeah, thanks, Sean. Thinking about this a lot lately. I don't think anybody sitting in my seat, CFO seat, any finance seat isn't talking about this. And I think the biggest thing is cash was a lot more free and available, in the past decade. And now kind of the pendulum has swung and not necessarily the case anymore. So companies have to really understand how to tighten and make sure that, when they talk about growth, they understand that comes with profit. When I talk about with our company, we're kind of creating our strategic vision. First and foremost, you have to map out kind of what your key performance indicators are, your KPIs. if your whole team doesn't understand what your goal is for the year, whether it's top line and bottom line, that's the foundation to really set the stage for your team to start the conversation, to understand, what you're driving towards in the year. You can't have an expectation to grow 100% on your top line, and at the same time expectation to grow, the same on the bottom line. It takes profits to grow. And when you're thinking about it, in the past several years, inflation has impacted every business. It doesn't matter, if you're a service industry or your, products, it impacted. I think the only thing that I've seen, particularly this year, that has softened a little bit is freight and some plastic, cardboard. But beyond that, companies are still struggling with that. And at the flip side, retailers are pushing back more. So it's no time like the present to really truly understand what growth you're looking for your company and profits. And at the same time, when you're talking about growing the top line, you fully have to understand what that means from a contribution margin associated with, a retailer. You have to understand what it's going to take to say yes to that retailer, and understand that some of those times it's going to say no. A lot of companies in the past have thought, oh, we can just say yes, and we'll make up the profits later. And that's just not the case anymore. It takes this much longer to make up those profits. And so making sure that you're fully aware as a team what your goals are from top and bottom line, and then also, what are those guardrails around when you could say yes to a retailer, when you're going to have to say no, to make sure you fit within those guardrails and those KPIs.
Awesome. Taylor, any thoughts on either what Liz just shared, or just, again, as companies are just prioritizing profitability?
No, I think Liz hit a lot of great points, as far as kind of the right things to think about. KPIs, alignment of what we're trying to achieve, the fact that capital used to be free, now the party's over, now it's expensive. If I could complement maybe two things, I would say, one responsibility of the CFO with the rest of the leadership is to also really think about the incentives and the redesign of the incentives in an organization, because a lot of the times I feel like the incentives haven't kind of caught up to the new reality. We're still incentivizing people and measuring things more aligned to the past 10 years than the current operating environment. So it's critical to think about getting that right blend of incentives, and it's about growth and profitability, right? It's not one or the other. And so where do you set the spectrum of growth and profitability, and how you want to set those incentives and reward people and kind of align the organization around those two concepts? And then maybe the other thing that I would just add is, it's so important for the CFO and kind of the finance community to be the standard bearer of being choiceful and kind of embracing this concept of scarcity, because there was many different things that could be pursued in an environment where it was easy to raise capital and the cost of that capital was very low. And now it's about being deliberate and really kind of prioritizing and thinking about resource allocation in a more thoughtful way. And so in every interaction, in every kind of concept across the organization, and just instilling that culture and being the standard bearer consistently is going to be very important, especially in these times of change where the pendulum has swung back so far so fast.
Yeah, and I'll just quickly jump in as well. I think you guys nailed it. And I do think it's notable, right, that a core fundamental tenet of finance, aka profitability, EBITDA, has become a buzzword. Or is kind of considered that, right? It's pretty notable to see that. And if you go back and I think about some of the people I've worked with over time, so the best CFOs and people in those areas, they've never lost sight of it. And there's always that focus on how to get towards profitability, even when you're not, right? And having a plan towards that. And so I think it's important to kind of call that out. There's also a lot of that interplay between the CFO and the CEO or president of working together to balance that, right? So it's important to have a CFO with a profitability mindset, but an understanding that, hey, there may be some times where there's a trade-off, as you guys mentioned both, and to be appreciative of that and understanding that it's maybe greater in the longer term best interest of the business.
Yeah, and I would just like one more thing, and
please.
as we kind of close it out, it's just, there's no time like the presence to be looking for any cost efficiencies through the organization. I think it's one of those things where I've been at companies where it's like, oh, it'll come, we'll scale, we'll find the savings. Always, it should be always on trying to think about how we can find more savings, whether it's a quick RFP or, leaning into advisors or any individual that can help you with your path to figure out how to get there. It should be always part of the conversation to think about that.
Yeah, and I just add to that as an investor, right? Like we've heard for a long time about, hey, margin improvement projects and that sort of stuff. And a lot of times we get a giant list of all these projects that are going to happen eventually in the future. And people have been bit by that so many times over the past several years that there's just not a lot of belief. And so starting early and having that perspective around margin improvement and having those projects and being able to show actual benefits over time, I think is a huge part of it, especially if you're looking for investment.
Yeah.
Awesome. Building on the profitability conversation, I want to talk a little bit about e-commerce and direct to consumer. From our lens, we particularly at late 2020 into 2021, we've seen a significant investment in direct to consumer teams, digital marketing, e-com. Over the last 6 months, however, we've seen this massive shift or expansion of focus into brick and mortar retail. So I think the question around that, I would have is, has D2C e-com remained a relevant, important channel, or has the importance of profitability deprioritized D2C for a business? Raj,
Yeah, I'll speak to that real briefly, Sean. I think, and just a little bit of background, as almost everyone knows, right? Before COVID, e-commerce was a little bit more, I just wouldn't say it's afterthought, because some businesses, it was very much a big part of the strategy. But post-COVID, everyone really wanted to kind of come in and really blow out their e-commerce channel, almost at the expense of their brick and mortar side. And then, like everything else, just talking about profitability too, it's a swing back and forth. And now you're kind of swinging in the middle of trying to find a balance between the two of them. And I'd say this, right? I think one, it assumes that e-commerce comes at the expense of profitability, which by and large, I'd say is you see it, right? Just from the P&Ls I've seen, they just haven't been as strong from the e-commerce perspective versus brick and mortar. Huge generalization, right? There's always examples and stuff to the contrary. And I think now people are kind of, as we talk about swinging back and forth, they're trying to find that happy medium between the two. And, e-commerce has a lot of called intangible benefits from the marketing side of it, stuff that you necessarily can't quantify. So I think it's still important as a part of a business as a whole, just from a channel strategy perspective. But you see a lot of folks kind of, trying to do a little bit of both, and that's tough. If it's an e-commerce business to start and you start going to brick and mortar, then you start cannibalizing your business. If you're brick and mortar, then it's tough to make your economics and pricing work. So I think for CFOs and people who are thinking about this question today, I'd say it's really important to have a good pricing strategy, to really understand your P&Ls, right? That goes without a doubt, of your e-com, your brick and mortar, and everything else, and to have it down, right? And understand the trade-offs. And then to be able to understand what balance and mix you can really support and have as a part of your business, because you don't want to swing too far in one direction or the other, because then it'll turn it upside down. So long-winded way of saying there's absolutely room for both. It's just going to be, call it somewhere in the middle for a lot of businesses, of having a little bit of presence in both channels.
Awesome. Thank you for sharing that, Raj. I want to switch gears and talk through banking. Taylor, would love to hear from your perspective, just giving your experience within Treasury and navigating the recent changes within the banking industry. Any suggestions, experience, share, advice you would share with potential growth stage brands in consumer?
Yeah, thanks, Sean. I mean, it's a funny topic lately, right? Because I think it's gone from, for early stage kind of growth companies, a topic that can be safely ignored by a lot of boards, to a topic now where I'm getting questions that I never thought that I would get, right? Like specific questions about who is the counterparty for certain investments that we're making. And so it's just topical for very obvious reasons. In thinking about a company's kind of approach and strategy when it comes to banking, to treasury, I would say a few things. One is now it's more important than ever to think about really kind of stress test scenarios. So who are we working with and how are we protected against various risks and how do we mitigate those risks? Create redundancy, give the business continuity in scenarios where I don't have access to a particular banking partner, and really just kind of set up risk mitigation strategies. So I'd say that's more on the defensive side. I would also say, given the rate environment that we're in now, there's a very high opportunity cost to not be as thoughtful as possible when it comes to investing strategic cash, right? I think if you were more lazy about that choice in the past, there was a negligible difference in what your cash could do for you from a yield perspective. And now it's much different. I mean, I was offered a 5.5% certificate of deposit from a large banking institution the other week, right? I mean, these are meaningful rates to kind of put your cash to work, to be very thoughtful about how you're going to invest, and to align with your fellow leaders, the CEO, the boards, about what your objectives are. I mean, when really thinking about, yes, we would like to generate some additional yield, but we want to preserve capital, right? Like, we don't want to turn ourselves into, an investment institution. And we want to build in some cushions in how we're thinking about these various liquidity strategies and investment strategies. So I would say my advice would be to kind of sit down and think about what you're trying to accomplish and what the guardrails that you're going to put in place and the governance around that for yourself. Align that with the key leadership, and then act on it. I think because there is an opportunity cost, as I said, to not being thoughtful about that as soon as you can.
And I think also, like, on the offense side, I was on a panel at Expo West, and, we talked about, how it's ever more important to be, in the know with what's happening at your bank, and your banker also in the know of what's happening with your business, kind of taking them along the journey, because it's not like you can go to them the next day and say, oh, I need more cash. But the more you take them along in the journey and keep them informed, whether it's quarterly meetings, touch base, it makes it easier if you do, to, Taylor's point, you start to plan out what needs are over a time period. You're better suited to be able to go ask for those if they understand what's happening in the business. And I've worked with some smaller brands that, have needed lines, but they don't have the EBITDA that necessarily banks want. But, there's creative ways that they can get around it. And there's, creative ways that they can put, capital together for them. And I think, part of that is finding institutions that understand CPG, understand, high growth companies, but, they're out there, but making sure, too, that they are kind of part of the business and part of the story, and making sure they're taken along the journey is always my best advice.
One more comment that I would add is that, we know it's a difficult fundraising environment right now, and those relationships with the bankers can pay dividends when it comes to facilitating introductions, kind of connecting dots to the ecosystem of the investor community, et cetera. So all the more reason I think that Liz makes a good point. It's, it can be for your own self-serving interests. It makes a lot of sense to stay close to, to those people, and the dividends of that, kind of close proximity can come in unexpected ways.
Love that. Great points. Not only around banking strategy, but thinking through the overall investment strategy. I think, Taylor, you mentioned that as well. Raj, building on that, if you think through, different sources of capital, to the extent that a brand needs to raise money in the next 12 to 18 months, does a brand prioritize existing investors, new equity, debt, or some other forms of funding, and why?
Yeah, the short version is, and it's always the worst answer, is it kind of depends, right? And as you think through all the different forms, the first thing I'll just quickly say, right, is 12 to 18 months is, call it, is a pretty common time frame that people are thinking through. But the reality is it's unclear, right? So just fundamentally with a business, you're trying to provide liquidity for the next 12 to 18 months while also working with them to kind of create a structurally sound path to profitability for a business, right? That's the only way you really get out of it is by not needing money, for lack of a better term. But as you go back to the different forms, I think people always default to who they know and what they know and what they know well during times of, call it crisis or times of uncertainty. And so going back to people that know you is much easier. And a lot of people that have invested in a brand don't want to see it fail, and they want to make sure that there's liquidity to really play out that thesis and have enough time for that brand to survive. I've also seen a lot of brands that are doing a great job of looking at alternative sources. So, at Cabela's, we had our head of finance was Joe Rodriguez, and she would come up with another source of income or finance or alternative cash to equity every single day. And, you can hit almost any part of the business. There's a lot of people that do a great job of, for, AP floating, for equipment loans, for lines of credit. There's a whole bunch of ways you can kind of go and lever your business. And what I would tell the people right now is you do what you can get at this point, right? Where it is uncertainty, where it's difficult to raise money coming in. So I would encourage every CFO to look at every form out there, right? Obviously I'm always a default equity as an investor, but it's not necessarily always sound for a business, right? There's other better alternatives for them in the short term. So that's again, another long-winded way of saying that it's important to look at every different source that's out there and consider everything in this environment until things start swinging back the other way, where cash is a little bit more free.
If I could add one thing to what Raj is saying, I think it's right to be looking at kind of what's the menu and what can I go after in a way. One thing that's always a challenge for the CFO who's usually leading a process like this is the time commitment, right? Because you are going to be devoting a significant amount of time to having these conversations, going through the diligence, et cetera. And it can be a real suck of your bandwidth from other priorities and initiatives for the business that are required. So I think approaching that in a way that is mindful of what's the highest kind of ROI that I can get for the business based on the time that I'm going to develop into different relationships, into different conversations, and being very disciplined about that can go a long way. I also would say that from a diligence perspective, there's many kind of visible examples of people and investors who have invested in businesses lately, and there's been some unpleasant surprises. And I think that the overall approach on diligence from the investor community, and Raj can comment, but I think gone are the days when you get a phone call and then 10 minutes later you can get a term sheet, right? I think people are going to be much more into rolling up the sleeves, much more into kind of getting into the nuts and bolts of the business and understanding these concepts around unit economics, where you're going, the strategy, et cetera. So all to say, it's going to be a more involved and intensive process. And you just really need to think about how can I accomplish what I'm trying to accomplish in the least amount of time and most efficient way possible.
Yeah,
and that's well said.
Yeah. I think also, Taylor, like what you say, like the time commitment, you got to make sure that you understand what your ask is. And it's not a 12-month, it's you need to look out 2-3 years to understand, because trying to do that annually and expecting your CFO at the same time, then you're trying to understand why we can't get the cost efficiencies, why we're not seeing, the visibility in our organization, or books are not getting closed in a timely manner. You have to look at like the priorities that are on their plate and understand, this isn't something you can do on an annual basis. So you need to be well aware of what's needed.
Awesome. Thank you for sharing. I want to talk through just some potential advice for aspiring CFOs. And Liz, would love to kick it off to you. As someone who's held a head of finance role and then worked their way up to eventually a president with Perfect Snacks and supported that business through an acquisition, what are some qualities and skills that you look for when evaluating a potential CFO? And how has that changed from when you were in the head of finance seat?
Well, I would say first and most important for me is that you understand the whole business, that you don't have tunnel vision on just what the finance department is doing. You have to understand what marketing, sales, because it's all storytelling. So when marketing comes and sales and you're putting towards the budget, you need to understand why they're doing it. What's the ROI? What's the purpose of the spend? Is it to grow top line? Is it to grow awareness? Whatever it may be. So I think first and foremost, like as I grew in my career, I came out of that tunnel vision and, really played, and you're a cross-functional support. And I think that's one of the hardest things I would say about being in a CFO seat or head. You're always going to be a support. And you have to really understand that, and then making sure that first and foremost, you're educating individuals in the different departments on why you're asking for what you are or why you're doing what you're doing, and then receive the same feedback. I've always been a firm advocate of making sure that each of my departments run their own budget. They understand, favorability, unfavorability, and where it's coming from. They're the ones who put the budget out there. They need to be able to maintain it, giving them the visibility to be able to do it and make themselves and their team more educated. In addition to that is making sure that you're holding meetings with the teams to see what else support can you provide them. Is it, are there people they need? Are there different processes? Is it systems? As a support function, you have to be able to support the whole organization and not just the finance department. And I feel like as my career I've grown, I've got to see more and more of the picture, different challenges businesses go through at different times, whether it's economic or just own personal business challenges. And it really just starts for me, that's development. To me, it helps develop myself to bring it to future companies, because I guarantee you anything that I've seen, other companies are seeing. And so also it just helps to understand, with my team and how I developed my finance team, is making sure working with them to, have the same mindset as me. I can't have an individual on the AR team or AP team that doesn't have the same understanding as I do. In addition, I think what's changed from before to now is individuals want to be more involved in what's happening in the company. So making sure that top down, bottoms up, everybody understands, company KPIs, what we're marching towards. That's why, like, in the last two companies I've worked with, we've invested heavily in Lattice, which is an employee engagement platform. We have all of our KPIs out there. They're visible. Everybody on my team fully understands, what we're trying to march towards, what are our accomplishments, where are we yellow, where are we red, and what we're going to do to pivot and change. So I think the visibility has been my biggest difference in previous to now. Is employees, team members, they want more visibility in what's happening in the organization. And so it's making sure that you're bringing them along that journey and helping them understand the why.
I think that was like a textbook answer, right? I fundamentally agree with across what you're saying on that. I think it makes a ton of sense. I would just add two quick things to that. One is, I think you were probably more tech savvy than I was when running the business. But for us, even simple things like even a monthly all hands, where our junior finance folk can get a chance to present and understand all the different parts of the business, right? As you talked about, I think is important in a pretty cost-effective, easy way to do it. The other thing I'll just quickly add as well is that mastery and that globalness is really what separates that manager level to that VP, CFO level. And the other part I really see is just a complete ownership of numbers. And it's not a ownership of numbers in repeating and reporting. It's ownership of numbers of understanding the why and being proactive when something happens or comes up. And so if there is a making up, right, some overspend in some area in marketing, for example, as you in your example, Elizabeth, right, of how everything comes together, it's understanding the why and understanding that is that actually for the better of the organization. The people I see are less good at that, or just say, hey, this number's off, right? It needs to be down. And so people that have that broader perspective and a full understanding of all the numbers in the context of the business, I think is huge. And being able to proactively identify things, whether it's trade or whether it's other areas that you see spikes in, and being able to escalate it pretty quickly, because speed matters for this stuff, is the other, call it, important trait I'd see as well. And just being ahead of it.
Awesome. Yeah, Liz, just to piggyback on what you just shared, it sounds like, really prioritizing employee engagement connecting them to the overall mission or purpose, and driving that down amongst the KPIs. But also, I loved how you talked about understanding your own skill set and building a diverse team to complement your skill sets, which I thought is pretty powerful. As we think about purpose and we think about driving purpose amongst the employees and understanding how important ESG as well as diversity, equity, and inclusion is, how are companies just balancing the overall trade-offs between financial sustainability and social impact? And we'll open it up to anyone who wants to.
Yeah, I'll kind of quickly just say, I think the first thing I just quickly say, right, is use the word trade-off, and it doesn't have to be that way, right? There's this mentality of, and it is kind of a prevailing perspective on it, but there's a mentality that if you do one, it's at the expense of profit, and I think that's just a poor way to think about things, and not understanding the upside to DEI and to ESG initiatives, because there's a benefit. And I think, there's two camps of folks that are out there. I think people understand how important it is. It's just the why they're doing it, right? Of, I'm doing it because I need an investor and it needs to be up there on the list, or I'm doing it because it's intrinsically important. And I think the folks that are doing it because they believe it's intrinsically important are seeing the best returns on it, no doubt. And so I think it's still extremely important. And I think it's if you think about going to where the puck is going, right? Not where the puck is today. This is the future. And so having the wherewithal to think about it now and start putting things in place today, I think it's just going to be important. Even if it's not efficient, it will eventually be.
Yeah, I agree. I mean, I had a company one time that said they were going for a B Corp status, and I asked just the why. And they just said, just because we want to put it on our website. And to me, it needs to be part of your mission and your culture of your business. And that's to, Raj's point, it doesn't have to be a trade-off. It needs to be part of your storytelling. It needs to be part of your business and your mission, and it has to be looked at as important throughout the whole business in order to dedicate the time and focus to it.
Yeah, I would say this is going to be a huge topic. As Raj kind of alluded to, this isn't going anywhere. And I think for companies that are on the journey to being a public company one day, going through an IPO, et cetera, I mean, this is going to be a greater and greater mind share of the finance community around reporting, KPIs, kind of audit trails. I mean, everything from an accounting perspective to investor relations messaging. So I think it's very important, again, to be authentic about it, and to this really connect to your why, and it's not just window dressing and you're going through the motions. And there's so many developments happening from a reporting perspective to just stay very close to what's happening in the market. I mean, right now there's a lot of inefficiencies because we're lacking some clarity on a few important areas, but over time that will sort itself out, and we'll have rules, we'll have kind of playbooks, and we'll manage through it, but stay very close to those kind of market developments on this topic. That would be my advice.
Yeah, if people come into it think it's a trade-off, it's going to be a trade-off, right? That's simple.
And the reality is you are future-proofing your business if you are focused on those elements of creating an inclusive work culture and diversifying your leadership team or your board team, et cetera. So, definitely makes sense. I want to bounce back because an area that we talked a little bit on our prep call felt like it was important and certainly relevant, and it has to deal with CapEx. How are you thinking about CapEx specifically around investment in supply chain automation or self-manufacturing as a potential solve for profitability?
Yeah, so I think, when we talked about cost efficiencies and where you can drive those, CapEx for automation is one area that we're particularly heightened and looking at. especially as we scale and, it gets more costly, taking our product outside of manufacturing and taking it to a pack out house to either put it in a display or pouching or however your format is, but looking at automation within our facilities to be able to run more efficiently, but also from a cost efficiency. So we're typically looking at it, for reduction of labor or reduction of using outside third parties to do stuff that we could do in-house within our facilities.
I would say, oh, go ahead.
Please, no, please, Taylor. You.
I would just add one thing. There's going to be a lot of kind of CapEx proposals as a finance professional that will come across your desk, and then we'll say, if we do this, there's this payback, there's this return on invested capital, it's going to make us that much more efficient, et cetera. And I think it's very important to analyze those opportunities with a very healthy opportunity cost mindset into what else can be done, not only from a financial perspective, but also just with time and focus. And I think that can get lost sometimes. You can say, oh, this looks great, why wouldn't we do that? But really examining those opportunities, thinking about what is my opportunity cost for doing this and not something else over here on the other side of the business. And then also with just a healthy amount of humility when it comes to execution and implementation. And I think that oftentimes we'll have cost overruns. We will not be as efficient as we thought. We will not have the right team to kind of get into this new area of the business that maybe is not something that we're as familiar with. So, I would just also say I take a very high bar when it comes to manufacturing, and in-housing a lot of these things that may be new muscles for the organization.
Yeah, I think that's well said. Now, just quickly add, right, as we go back to that theme of swinging different ways, if you go back 10 years in corporate M&A, it was no one liked self-manufactured business, right? They wanted everything to be asset light and easy to plug into it. And then, come COVID and supply shocks, it's what do you control now, right? And how do you have your own self-manufacturing? So I think the right answer is, like everything else, is somewhere in between versus these swings. And the caution I'd say for CFOs as well as they think through the CapEx requirements is, a lot of times what I'm seeing is that companies will invest behind it, and then either given the market or given the timing or the premiumness or whatever it may be, the demand doesn't come, right? Because then you're left with an absorption issue. And so it's being really smart about how much you invest behind CapEx, and not necessarily always assuming, hey, if you pour that money in, if you build it, they will come, right? It doesn't happen that way. And understanding what the downside would be, right? And being able to manage the business if that demand doesn't come to fill up the capacity.
Awesome. We have a few more minutes for those that are in the audience. If you want to ask a question, feel free to in the chat. And in the meantime, I'll ask another question or two. Particularly, well, just to add to the conversation on self-manufacturing, trends that we are seeing are brands that have their own internal manufacturing are definitely investing in personnel. So we've seen an increase in demand from those companies in particular. So it goes to a lot of what we're all talking about in terms of, I guess, the added layer of margin where they can invest in additional personnel. So just, I guess, an experience share there. But going back to the conversation around the ideal role of the CFO, Liz, you talked a lot about supporting and really understanding kind of all of the divisions. But I also know there's an element of accountability there. And so would love to kind of hear, Taylor, you're in the CFO seat, and Liz, feel free to chime in as well. How do you balance the accountability with support?
Yeah, I think, my perspective on kind of accountability and support is part of being accountable and managing with an accountability mindset is knowing where your gaps are and what you're going to do to kind of narrow or address those gaps. And so I think it would be irresponsible if, as a leader of a function in an organization, you knew that, hey, I'm not particularly strong on treasury, or I'm not particularly strong on FP&A or accounting, or or investor relations, and you didn't do anything to address that, right? To bring into with the team the right skill sets to kind of complement you. And that doesn't give you a free pass to say, okay, now I've outsourced this aspect of the function and I don't need to think about it anymore. Quite the opposite, right? I think you have the responsibility to partner with those individuals, to learn from them, to close those own gaps yourself from a leadership perspective. And we should all be on this constant kind of self-improvement journey where we are saying, what could I be better at? And doing the work to kind of close those gaps. So I think that they coexist, and having support doesn't relieve you of that ultimate kind of singular accountability.
Yeah, and I think I love that point, and I think the other thing to think through is how, a CFO is measuring himself and his team. When you look across, how you're measuring cash, DPO, DSO, all the key metrics, and making sure, they're aligned with, what the company's looking to do that year. Because, same thing we talked about cash. And if you have a working capital plan that doesn't meet what the company's looking to do, that's a shortfall. So making sure that you have the right key performance indicators for the finance team, the accounting team, and then in addition to the finance team, as it comes to reporting, month-end close, how are you analyzing different aspects of the business? But to Taylor's point earlier too, outside of, if you have those gaps in treasury, I go back to the earlier conversation on bankers. They're also how are you using your vendors? How are you using your tax partners, your audit partners, your bankers to help support the accounting team as a CFO? It's not just you. You're not alone in it. You have a lot of people surrounding you, that you can leverage to for insights or how, best practices.
Awesome. Perfect. Well, before we wrap up, would love to end on a high note and see just from each of the panelists to share just a final thought. And Liz, why don't you kick it off for us?
I think just most, my final thought, and we talked about this earlier, is just making sure you have a clear understanding with your senior leadership team, what your goals and focus are. I think focus is more important than ever with rising costs. Making sure that you're not going far and wide and you stay a little more narrowed. But then making sure that that's cascaded down to the whole organization so everybody is aware of what the goals and where you're trying to get through.
Raj, do you want to?
Yeah, I agree with that. And I'll also just quickly add as well, we talked a lot today about, call it like that mastery of the entire organization and having the broader perspective, right, than just the numbers. And the other thing I'll just quickly add of what I've seen of really, really great CFOs are people that it's kind of the people side of it's a little bit ignored to a certain extent, but it's ways to be able to talk to the team in a way that's understandable. It sounds so simple, but it's so important that they understand why the financial side of it's important, why it's really crystal clear, and being able to be true partners with folks and also having some optimism, right? Which is something that's kind of misses a little bit today with the stereotype of a CFO, but it's always good to have her have called a broader perspective or knowledge of the business and being able to have that optimism, which to get people behind it.
I think those are two great ones. What I would say is I have a high disdain for thinking of finance as a support function. And I think that, finance leaders, we are so privileged in the fact that we have access to so much information across the business. And we can connect dots that are very difficult for other people to connect. And so I think Raj mentioned, kind of proactivity earlier, but I would say, living up to that privilege of having access to that type of information and to be able to kind of connect those dots and really just be extremely proactive in thinking about what can I do that can add value to the CEO, to the boards of the organization. And there is no shortage of, say, of opportunities in this market, given everything that's happening, for you to be choiceful about those things that you want to go after and suggest those kind of initiatives. So I would say proactivity and energy in pursuing those would be my final comment.
Awesome. Awesome. Well, thank you all for joining us today. Again, truly three of our industry's best here. Liz, Taylor, Raj, insights and trends you've just shared is, I think, really helpful for a lot of the audience that's on the video now, but also we'll be sharing it with the rest of our network and community. So thank you all. Really appreciate it. And best of luck.